Aloha, friends. Amanda here, and welcome to the Business Finance Coach on YouTube. Today, I'm going to be going through 3 traditional ways to finance your business, and I'm going to go through how I would tweak these traditional ways to apply specifically for small business owners. Be sure to also check out tomorrow's video, which is 7 alternative and business savvy ways to fund your business startup or expansion. Before I start telling you ways to get a bunch of money for your business, I do want to tell you about financial risk. Now, your willingness to take out a big loan or to take on financial risk by taking money and owing it back later is part of what will make you a successful business owner or has made you a successful business owner. However, you want to be careful with the amount of financial risk you take on. So it is a very fine line of not taking on too much so that you're overextended. Number 1 for traditional way to finance a business is bank loans, of course. When you're talking a traditional business bank loan, what that means is that the bank loaned the business money, not the individuals who own it or who run it. They lended the money to the business. So if the business can't pay the loan back, then the business is held responsible. When it comes to smaller businesses, we're always personally held to take out the business loan. Typically, most smaller business situations, certainly startups, the individual is held responsible. So in order to get a true business bank loan, typically you must have been in business for 5 years, and then the bank will look at a number of criteria to come up with an amount that they give you, a revolving amount of credit. If you're interested in getting a business loan, you want to form a relationship with a bank and a banker and specifically find out what they're looking at. So some banks will look at accounts receivable and base the amount of your business loan on the amount of your accounts receivable. Accounts receivable is what your customers owe you at any given point in time. You can structure your business so that you have accounts receivable by planning, if that's what you need. So really understanding what the bank is basing their decision on is critical for you to be able to plan your business to qualify. So that's the traditional way, is the business loan. When it comes to kind of tweaking that traditional way of funding for small business owners, I would refer you to SBA loans, which is the Small Business Administration. They have loans for small business owners that are far easier to qualify for. They have loans for equipment and real estate remodeling for locations. And they also have working capital loans, which I typically recommend staying away from unless the nature of the business model does require that to get started. Number 2, owner investment. So you may have heard of corporate companies, and certainly the tech industry is very popular for having IPOs where their stock becomes available for sale in the stock market. And because of speculation and interest in the industry, people buy up that stock. Forming a corporation is a very expensive and extensive process. For someone starting out, I would typically never recommend doing a corporate structure. So for small business owners, you are the owner, right? You're the owner, you happen to be the manager as well, and maybe you're who's working in the business too. But regardless, you're the owner, and you can certainly invest funds in your business. 2 ways to do that. If you have good credit or you build up to having good credit, there are 0% offers from credit cards, cash up front. So if you have the good credit, you can certainly get a lot of those. The second way could be taking out a mortgage home equity loan on a property. Now, the one other example I have for tweaking this owner investment of the corporate model is a type that I'll be talking about a lot more tomorrow in the alternative ways of funding your business. If your customers really want whatever it is you're offering in your business, they may have an interest in helping you get the startup money you need because they want this service or product that you're, and maybe only you, are offering them. So they may have an interest in upfront investment if it somehow, benefits them being able to get these things. Why do people buy corporate stock? They think the company is going to do good. So anyone who likes what you are trying to do with your business or the business you're trying to start, they have an interest in helping you do that because they have the same sorts of values as you. Number 3, partners or private loans. So what this means is kind of along the lines of what I was just talking about. If you meet someone who has an interest in what you're doing, and they're considering themselves an investor, a lot of people like to invest in things they like, and really developing any relationships with people you meet who may be interested in investing with you. There are partnerships where you're actually forming a business together. One partner can be the investor. They're silent. They can have nothing to do with the business and they just put in the money. You can be the other partner where you have ultimate control of the business. You don't put in any money, but you put in your time into running the business. So there are those types of relationships. However, it does take funds to start a partnership. You do need to get a lawyer and be very clear about the agreements you set up, because I see people get into some sticky situations when all the parties involved really didn't understand the partnership agreement, which details how it's all going to work. The other thing, if you don't necessarily want to form a partnership with someone, because that is kind of a big deal, starting a business together, they could also just give a private loan to you for an amount of money that you agree to pay back. And that's also much simpler as well. All right, so that's it for the 3 traditional ways to finance a business and how they apply to small businesses. So the first one was bank loans, and of course for the small business owners, SBA loans. The second was owner investment, like in corporate IPO offerings. For small businesses, as the owner, you can invest 0% card offers or a mortgage on your second house. And then, of course, getting customers to invest as owners because they want to help you get started and be an owner in this service or product that you're offering. And then number 3, partners or private loans with people who have an interest in you being successful with your business. Thank you so much for watching, and keep in mind that however you fund your business should be strategic. And I'll be talking more about that tomorrow in the 7 alternative and business savvy ways to fund your business startup or expansion. And also, I am running a 7-day business planning challenge to write your business plan in 7 days. With me, I'll be doing a live stream every day, walking you through the process, making it super easy to focus on the strategy and to get a solid plan. Okay? So thanks again for watching. You can find that link somewhere on here to sign up for the business planning challenge, and I'll love to see you there or see you in tomorrow's video. Aloha.